Okay, good afternoon, everyone. Let's get started. This is Lei Ding from Federal Reserve Bank of Philadelphia. Welcome to today's webinar on small businesses. This webinar is the third session in our Research for Equity in Recovery series, which is co-hosted with the Penn IUR and the Upjohn Institute. Our goal with this webinar series is to create a platform to discuss the up-to-date research and best practices that could inform a more equitable recovery from the pandemic crisis. I want to start with the standard disclaimer. The information analysis and conclusions set forth are those of the panelists and do not necessarily reflect the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. Before the panel discussion on this very important and timely topic, I want to mention a few housekeeping items. First, after this webinar, we expect that this series will resume in about a month. We're finalizing the agenda for several new sessions, and you should expect us to receive the invitation very soon. Second, today's session is being recorded, and we will post the recording and other supporting materials to our website shortly. We also encourage you to use the Q&A function that you can find in your Zoom toolbar to ask questions anytime during the session. Finally, I'm very glad to introduce today's moderator, Tim Bartik, who is a senior economist at the Upjohn Institute. Thank you, Tim, for putting this wonderful panel together. And without further ado, I'm handing it over, I think, to you now, Tim.
Thanks, Lei, and thanks for all your work on this and all the work of the people at the Philadelphia Federal Reserve Bank, along with the Penn Institute for Urban Research for sponsoring this, along with the Upjohn Institute. So as Lei said, we're focusing on equity and recovery, which means not letting anyone behind as we have an economic recovery. And so far we had a previous webinar on job training, not leaving workers behind. And we had a session on place-based policy, not leaving any place behind in the recovery. As Lei mentioned, we'll have others in the future on equity issues in the recovery, but today's session focuses on the very important topic of small businesses. How are small businesses doing currently in this pandemic recession? How are small businesses doing that have Black owners or Hispanic owners or otherwise may have greater challenges? And what can public policy do about it to be helpful to small business to make sure they're not left behind? We have 3 speakers. Each speaker will speak for 10 minutes. And then we'll have time for questions and answers. And so as Lei mentioned, there should be at the bottom of your screen or somewhere on your screen a Q&A thing you can click on. If you have a question at any time, please post it there. I will be looking at that during the session, and at the end of the 3 speakers speaking, I will try to ask of the speakers as many of those questions as possible. So please feel free at any time if you have a question, please type in the Q&A box. So you can see on the screen the speakers we have today, and I'm going to introduce them verbally, though, one at a time when each person is up. Our first speaker is Marianne Bertrand. Marianne's a professor of economics at the Booth School of Business, University of Chicago. She's a very well-known and prolific researcher on a wide variety of topics within economics, including labor economics. And she'll be giving us both a general picture of the labor market and business consequences of the pandemic recession, but also including evidence from a database that emphasizes the trends of many small businesses and also has some suggestive evidence for the effects of PPP, the Payroll Protection Program. So I'll now turn the speaker role over to Marianne. Thank you.
Thank you so much, Lee and Tim, for the introduction. Let me make sure that I can move. I can move forward. Yes, great. So just before, I should say that this presentation is based on work with Tim's favorite son, Alex Bartik, and as well as Jesse Rothstein, and two PhD students at Berkeley and at Chicago. So let me just highlight the goal of the work that we have done here. So our first goal was really to try to understand the labor market decline at the onset of the COVID-19 recessions, sectors that were more affected. We trying to understand the timing, which workers were more affected, and the role that firms, especially small businesses, kind of played into all this. And the second part of the presentation, we look at very preliminary evidence on the labor market effects of both the shutdown orders and reopening orders, as well as some of the other economic interventions that were part of the CARES Act, and in particular, the expansion of UI benefits and the PPP loans. So let me start with kind of the broad picture. So this first graph kind of looks at employment declines for the kind of private sector overall, and also by economic sector between February and April 2020. Those are the light shaded lines. And to put this in context, we compare that to the employment declines that occurred during the Great Recession over the period of November 2007 to January 2010. So this picture, I think, makes it clear that the shock that was experienced over this very short 2 months time period was massive. The employment declines for total non-farm kind of payrolls was about 50% larger than the employment declines over the more than 2 years period of the Great Recession. That's fact number one. The other thing that's also very clear about the pandemic recession, it's very different in terms of the sectors that it has affected most, again, compared to the Great Recession. You can see, not surprisingly, that the leisure and hospitality sectors, as well as other services, which are mainly low-wage services, were far more greatly impacted by these recessions than other sectors in the economy. And this is really in contrast with the last recession, which affected way more construction and manufacturing. So this is not the usual men's session. Those sectors that have been more impacted, also sectors that employ a much greater share of women and low-wage workers. What's also true about this recession, and I think that goes hand in hand with how quickly it happened, is that it was associated with much higher rates of expected recalls. Lots of workers that lost their job over this 2 months period had expectations of being recalled. And I'll come back to some further evidence on this in a subsequent slide. The focus of this webinar is on small businesses. And even though I'm going to say a lot of things that are more general about what's happening in the labor market, I'm also going to be, featuring and focusing a lot on small businesses. The reason why we can do this is that we have developed a partnership with a company that's called Homebase. And Homebase essentially offers a scheduling software for a lot of small businesses in the US. So they cover tens of thousands of small businesses in the US, hundreds of thousands of hourly workers working at these businesses. The Homebase clientele is pretty representative of the United States in terms of its geographic distribution, but the kind of small businesses that form their client base are very small, as you can see on the first graph over here, and they are very much focused on the food and drink and retail part of the economy, which as we've just discussed in the prior slides, were clearly the sectors that were most impacted by the recession. What's great about the Homebase data, and we're going to leverage that in the next few slides, is that it really allows us to track hours and employment at these businesses at a very high frequency. In fact, on a daily basis, we can track hours at these businesses. And this is what we've done essentially since mid-March when the crisis hit, to see how things have evolved over time for those businesses and the workers at these firms. So this picture, again, with our focus on small businesses, I think you should look at the red line, but it's going to be useful to put that red line in perspective, really shows us what has been, the extent of the labor market collapse during COVID. So what you see in the red line is essentially total hours at these small firms that are the home-based clientele. All of these benchmarked to the last 2 weeks of January. So benchmarked to hours at the end of January in this business. And what you can see is a massive collapse of hours at those businesses that is extremely sudden. Essentially, all of the action, all the collapse took place in the last 2 weeks of March. And this is based on the daily data that we have access to, where, if you think about the trough of this, the lowest point was essentially in mid-April, where hours at those businesses were essentially 40% of what they were pre-COVID. Since that time, since mid-April, we've seen a fairly steady but slow recovery. And, the data that we are presented here, even though we are now able to extend, goes to the second week of July. So you can see a recovery for these small businesses up until about late June, and then what seems to look like a beginning of a stagnation in recovery, and I think early signs of things kind of going back in the wrong direction, going back south somewhat. Now, if you compare the red line, which is those very small firms at home base, to the blue line and the stars and the crosses above, you can see really that those small businesses were way more impacted. The blue line comes from a company called Kronos, which it also offers these scheduling services, but tends to have a clientele that has got much larger firms. So the blue line kind of does the same exercise as we do in the home-based data, not on a weekly base, because that's the availability that we have for the Kronos data, but focuses on businesses with more than 100 employees. And you can see in terms of the shape of the curve, the timing, it follows the red line, but the collapse hasn't been as strong as it had been for the small businesses. And the recovery has been, somewhat parallel, but again, from a collapse that is, much smaller in magnitude. The crosses and the star refers to our standard, administrative data, the CPS and the CES, which covers the entire economy. And again, somewhat the same shape, but a much less extreme collapse at the onset of COVID. So clearly the small businesses have been affected much more. The next slide, further exploit the home-based data to try to tell you something about what exactly is behind the reduction in hours, right? So with the home-based data, we can essentially try to decompose this reduction in hours and see how much of it is coming from business fully shutting down, no hours at those businesses, versus layoffs, versus hours reductions at businesses that are still operating. And what you can see is that except for the very first week of the recession, the reduction in hours is mainly coming from either businesses shutting down or businesses laying off some of the employees. And the share of these two is about half. And you see the same kind of contributions of those two over time. There are, I think, a few interesting patterns in the data. I'm aware of time. It sounds like I'm going long. The data suggests that the businesses that have shut down and the businesses that have reopened are not, are not random. There's something systematic. So in the home-based data, it is very clear that the smallest of the small businesses in the home-based data were much more likely to shut down, have 0 hours in a particular week. And somewhat true also, but less salient, that among the businesses that shut down, the bigger ones were more likely to reopen. Another, I think, really interesting pattern in the home-based data is that we can compare, the extent of the shutdowns and the reopening based on the kind of growth that those businesses were experiencing between pre-COVID. And the data clearly shows that the businesses that were more likely to shut down in the early months of COVID, early weeks of COVID, were businesses that were already struggling in the prior year. So businesses that were going slow in the prior year were more likely to shut down. And furthermore, conditional living shut down those businesses that were not doing as well prior to the recession were also much less likely to have reopened. So I'm gonna have to speed up because I'm clearly out of time. Let me just say a few things about the pattern that we observe in terms of the employees, the particular workers that were most affected and more likely to lose their job and more likely, conditional on having lost their job, to be rehired. And what we can see here is that more disadvantaged workers were more likely to be impacted. So I'll stress a few things. Among the businesses in the home-based data and in the CPS general, it is the least educated workers that were more likely to lose their job. And conditional on having lost a job, it is those least educated workers that were less likely to be rehired. It is also the case that non-white workers were more likely to be laid off at home-based businesses and in the CPS. And also the case that conditional on having been laid off, non-white workers were less likely to be rehired. I think those are important patterns to keep in mind. This slide, very quickly, the main takeaway of this slide is to reinforce the points that we have made, but others have made, is that the impact of the shutdown orders and reopen orders in terms of explaining what happened over the last few months quantitatively is minimal. We saw a massive labor market collapse. If you try to conduct advanced studies and assess the extent to which shutdown orders in a particular state explain the collapse, the magnitude of that is very, very small. What has been happening is not being driven by these shutdown orders. It is really the public health concerns nationally that have been behind the reduction in hours and the drop in employment and the shutdown of those businesses. And then very final thing, as I'm out of time and maybe we'll have more time for the discussion, we try to look at some of the two biggest components of the CARES Act and what impact they've had on the partial recovery so far. So we looked at the data to try to assess whether higher UI replacement rates were associated with slower recovery, right? This is a big part of the concern that these very high replacement rates are discouraging workers from going back to work. The data that we have put together suggests that that is not true. There's no evidence in the data so far that higher replacement rate, higher UI replacement rate slowed down the recovery. And then the second big part of the CARES Act was this PPP disbursements. And there, the evidence suggests, again, very preliminary and far from causal, but whatever we can do so far suggests that the PPP disbursements has worked in that we see somewhat faster recovery in terms of hours at home-based businesses in those states that receive more PPP money, especially PPP money going to small businesses in the food and drink and retail sector of the economy. And I'll stop there, and I'm sorry I went long.
Thanks, Marianne, for that presentation, and that covers a lot of key points and what's going on in the economy due to the pandemic and in different business sectors and for different workers. So our next speaker is Chi Mack. Chi is the Small Business Research Lead at the JPMorgan Chase Institute, and she is going to present some evidence on the financial health of small business, including small businesses with Black or Hispanic owners. And she's using some great data that her institute has and that she spent a lot of time analyzing. And so I'll now turn it over to Chi.
Thank you, Tim, and good afternoon. Let me first say that for those of you who are not so familiar with the JPMorgan Chase Institute, we are an organization that does policy-oriented research using de-identified data from Chase. So we have a number of research themes. I will be speaking about the small business work during this session, but all of our research is available for free on our website. Now, as I said, our small business work has really focused in the last few years on cash flows of small businesses. So most small businesses don't borrow or anything like that, but they all have cash flow management problems. So we have a number of research reports that are available online about owner demographics, their cash flow patterns, and the communities that they serve. Also, I'd like to issue my disclaimer, which is that all opinions are my own and not those of JPMorgan Chase. Now, first, so when we think about small businesses, now usually what you hear about what is defined as a small business. So usually you hear that small businesses have less than 500 employees. And that's true, but actually the vast majority of small businesses are non-employers, or they're very small employers, just a few employees. So, and that is also what we see in our sample. So our research sample is based on deposit accounts. So these are business checking and savings accounts that business owners open at their local branch. These cover mostly metropolitan areas, so urban areas, and this is nationwide in our sample. However, we will also speak in this presentation about owner raise. So for that, for those charts, that is limited to businesses in Florida, Georgia, and Louisiana. And this is because we're leveraging voter registration files where race is identified and publicly available. So out of the 8 states in which this is publicly available data, only 3, which is Florida, Georgia, and Louisiana, overlap with a Chase footprint. And that's why we can only report owner race for those states. Now, today I will be speaking a bit about the pre-pandemic financial health of small businesses to see where were they kind of right before the pandemic hit, and with a special emphasis on minority-owned businesses. And I'll also be speaking about how they were doing during the pandemic relative to where they were last year. Okay, now let's start with revenues. So we can see that most small businesses, or the typical small business, is pretty small. We follow a cohort of firms that were started in 2013 to 2014, and we look at how they were doing in the first 5 years of operations. And you see from the left-hand chart, most of them are pretty small. For a white-owned firm, they're around 100,000 in revenues. But very strikingly, a black-owned firm of the same age is less than half that size in revenues. And so, and this is not just because, I think sometimes it's posited that perhaps Black business owners, Black entrepreneurs are choosing industries in which, firms tend to be smaller and have lower revenues. On the right-hand side, you see that that's not completely the case. So in every industry we see there's a gap between Black-owned firms' revenues and white-owned firms' revenues in the same industry. Now, revenues are really only as good as they can for covering expenses. So small businesses need to make a profit, just like any other business. And so you see on the left-hand side, though, when we look at the profit margins, also within the first 5 years and by owner race. So profit margins, again, they're not high across the board, but in particular for Black-owned firms, those profit margins are considerably smaller than for comparable aged white-owned firms. And this is really important because what the profits you have left over, that's what you have left to reinvest into your firm so that it can grow, or you can save for a rainy day for those adverse shocks such as the pandemic. On the right-hand side, you see this is our measure of cash reserves for small businesses. We measure this in how many days can your firm pay out your typical outflows in the event your revenues are completely disrupted. You can see for white-owned firms, it's 19 days, and that's not a lot, but it's a week more than what Black-owned firms have, which is the 12 days of cash buffer. So there is an indication that just going into the pandemic, the Black-owned firms just had less cash reserves on hand. Now, you may be wondering, well, even 19 days is not very much. That's true, and the pandemic has already gone on for months. Now, what's going on? How are small businesses surviving? What we see is that small businesses are able to cut back on expenses when things like this happen, and that's how they're getting through. Now let's turn to some of the hardest hit industries during the pandemic. Now, first, restaurants, of course, have been hit very, very hard with all the restrictions, as well as people just wanting to stay home. On the left-hand side, we'll see these are the difference in cash balances in this period relative to where they were a year ago. And see in the orange line, these are restaurants owned by white owners. So you can see one thing that you notice is a large jump in those cash balances in early May. So this is shortly after the second round of the PPP program applications resuming. You can see that once those funds flowed in, there was a sudden increase in cash balances when you compare that to where they were last year. And for white owners, that was a much higher jump than, say, for Black-owned restaurants. So you can see that the program has done something to kind of bolster cash balances. On the right-hand side, you can see where revenues and expenses are during the same period relative to where they are last year. And you can see that it hasn't really, there's been some recovery, but not completely. Let's look at the next, another hard hit industry has been personal services. So these are salons, dry cleaners, laundromats. And at first glance, it may look like here the blue line is much higher than, say, the orange line. So that Black owners have been doing better there. So I want to point out a couple of things. First, that initial jump in balances relative to last year occurs in mid-April. So what was going on then was actually the CARES Act stimulus payments. You say that, well, those were not geared towards small businesses. That's true, that was for individuals. However, remember that most firms in the sample are non-employers, so they would likely be pass-through entities in terms of their tax status. To the extent that they are filing taxes for their business on their personal returns and then listing the direct deposit account information for their using their business account, we see that those stimulus payments are getting added to their balances in their business accounts. And then second, you also see again in the early May, another kind of jump. And you may think here that, well, it looks like for Black-owned personal services firms, they're doing a lot better. And that's one thing that's true. However, you have to also remember that that Black-owned firms tend to have lower balances even before the pandemic. So when we're saying that these balances are increased, they're relative to those relatively low balances of last year, which were lower than, say, for white-owned firms. And so third, last industry I'd like to cover is retail. So as we know, retail has been very hard hit. And here we don't have a race cut, but what we want to emphasize here is looking at that not all retail is the same. So the darker line here is grocery and food stores. And as we know, as people are not going to restaurants, they're spending a lot more money at grocery stores. And we see that in the data, not only for the cash balances, but also in revenues. That darker line there, that grocery stores are doing a lot better than other retail. But at the same time, they still, they did also benefit from those PPP payments as well. So just to conclude, we do see that the cash balances have really been bolstered by all these relief efforts. And that's not only the PPP, but also the CARES Act stimulus payments that were geared towards individuals. We also see that some industry segments are doing, have been hurt much more severely. So they're, especially personal care services, and they're gonna need a longer path to recovery if they manage to survive at all. And as we're thinking about equity and recovery, we really need to think, not just about getting small businesses back to where they were a year ago or 2 years ago, because, especially for minority-owned businesses, they were not financially as healthy as some of their white-owned counterparts. Thank you.
Thank you very much, Chief, for that presentation. A reminder, if you have any questions, please post them in. There should be a Q&A button at the bottom of your screen or somewhere on your Zoom toolbar. And our final speaker is Maurice Jones. He is president and CEO of the Local Initiatives Support Corporation, or LISC, which is a great nonprofit organization that you should be aware of. It's been around for over 40 years and providing financing and support for community development and economic development in underserved neighborhoods and communities. He's going to talk from his experience about what policies would most help small businesses survive this current pandemic, particularly those in some of those underserved areas, and hopefully thrive in the aftermath. So I'll turn it over to Maurice.
Great, Tim, thanks. I appreciate it, and nice to be with you all. I do not have a PowerPoint, so you don't have to worry about following that. I'm going to just try to talk from some notes that I have, and to come at this through the perspective of a practitioner in the work that we've been trying to do with respect to small businesses during this COVID and recession season and racial reckoning season as well. So what we ended up doing, and the way I want to talk about this is we ended up aggregating an now it's up to $85 million pool of funds for grants for small businesses. And then we are actually a PPP lender as well. And we've lent about $50 million of forgivable loans via the PPP. We have focused our work on minority-led businesses. And so I want to sort of give you a sense of what we're seeing through the eyes of a practitioner that has been intentional about focusing on minority-led businesses, women-led businesses, businesses that are serving rural areas. Let me start with the grants that we're doing. So we have developed a grant product. We are providing small businesses with grants anywhere from $5,000 up to $25,000. And we're doing it through a competition. And this was our first sign of just what was happening with small businesses. We articulated at the outset that we really wanted to focus on minority-led businesses, women-led businesses, veteran-led businesses, businesses serving urban and rural areas. We went out initially with a grant round, a competition of about $2.5 million. We thought we would get about 4,000, maybe 5,000 applicants from businesses for these grants. We got 55,000 applicants from small businesses out there. We're on round 5 now of our grant making. We have received over 250,000 applications from small businesses for grants from, on average, they're $10,000 grants. I want to just tell you a little bit and give you a little data on what we're seeing. We are allowing these grants to be used in a pretty liberal way. So businesses can use them to fund the needs that they have to really stay open during these seasons. This is really a relief effort. What businesses are telling us is that they're going to spend the grants mostly on rent and paying for supplies and vendors. Those are the ways that businesses are telling us that they're going to spend this money. What's been real impressive for me is we have funded this by raising capital from people like Verizon, Sam's Club, US Bank, Truist Bank, Synchrony, P&G, Lockheed Martin has invested in this pool. Lowe's has invested $60 million in this pool, and the P&G brand Secret. So the investors for these small business grants have been larger businesses, actually, who are concerned about the health of the small business economy. Let me give you a sense of what we're seeing. I mentioned over 250,000 seekers of grants, and where we've come out and I'm going to turn to this at the very end when I talk about lessons learned, 90% of our grants have gone to minority-led small businesses. 64% of our grants have gone to women-led businesses. 85% are businesses that are serving low and moderate or are operating within low and moderate income communities. About 99% of the grantees have fewer than 15 employees, about 99% of them. About 45% of the grantees are businesses that have been in business for 10 years or more. So these are businesses that are the staples of these communities that we're trying to serve. These are not small businesses that have been on the verge of extinction, if you will. These are businesses that have been around for a while. I looked at our round 4 of grantees, and 54% of the grantees are in the construction, healthcare, or what we would call social assistance business. And that's the bulk of them. We're also seeing a great deal in the retail and service area, going back to the food stores. And then we're seeing hardware stores and automotive repair. Those are the most numerous categories or sectors of businesses that we're seeing in the grant category. The last thing I wanted to mention is we are coupling our grants directly to the businesses with grants to technical assistance providers who can provide consulting services to the businesses on various things, including technology needs. They're providing incubator services and accelerator services. And often we've found that technical assistance provision for these businesses is as important, if not more so, for their recovery or efforts at recovery and reconstruction as a direct grant to them. The grants are really serving the purpose of helping them stay open. But in order to help them reconstitute, reconstruct, we are finding that we've got to build a stronger business ecosystem around these businesses, just the way that the McKinseys and others of the world serve the same purposes for the larger businesses. So that's probably the essence of the grant piece that I wanted to talk about with you. Let me turn now to finishing this. I know I just have a couple of minutes with a little reflection on the PPP program. So we are a community development financial institution. We are a SBA 7A lender. That's what enables us to actually provide PPP loans. We decided that we were going to focus our PPP loans on nonprofit organizations and small businesses, particularly those led by minorities and women. And so we went out and aggressively marketed through channels to reach those organizations. We were seeing in the first round of PPP that the mainstream financial institutions were doing what you would expect them to do: serve their borrowers, serve their customers. Their customers are not small businesses of 15 people and fewer led by people of color. Ours are. So here is what we did with an intentional effort. We've done about 50 million of PPP loans. 65% of the businesses that we served are led by people of color. 56% are led by women, and collectively, women and minority led, we're over 80%. of our total, we actually did more nonprofits than for-profits. About 60% of what we've done have been with nonprofit businesses. The lesson for me of PPP is if you want to reach these small businesses, you have to use the channels set up to finance them. And you've got to broaden your notion of what the financial system in the US really is. CDFIs are the ones serving small minority-led businesses, and we've got to have them at the outset of a policy or at the inception of a policy solution for these small businesses and not as an afterthought. My apologies, I went over my time.
Well, thank you, Maurice. And now we're going to have questions and answers. So please continue to post your questions and answers in the Q&A button. And I'm going to start out, I'm going to ask each of the speakers a question that's related to policy. And I'll go in turn and I'll call on them. So I guess, Marianne, you documented that there's been some, after big downturn, some recovery, it slowed down. It's possible it may continue to slow down or even get worse. What should the federal government be doing now? Should we just renew PPP? Should we be doing something different if we're going to try to help these small businesses given the current situation? What would you recommend?
Gosh, that's a really, really hard question. But I think the starting point of this should be certainly that it's very clear from the data that this is far from the data, from the public health situation right now, that this is far from over. So simply not doing anything for these small businesses in the next round of government, kind of intervention seems like crazy. Kind of more is going to need to be done. The early evidence that we have is that, kind of the PPP model did work, even though, and I think Maurice stressed that, and I think, kind of the second presentation stressed that as well. It's clear that the implementation of this program was very far from perfect, that the targeting of the money to the small businesses was not there. So if there's going to be another round of PPP money, I would suggest being much more intentional in making sure that, kind of the smallest of the small businesses actually do get covered. So that's, I think, number one. I think the other thing that seems to be, to be true is that, and again, Maurice's presentation kind of stressed that, is being maybe more flexible as to, kind of what the money can be, can be used for the businesses would be important. But so I see no reason not to keep on with this model, but improving the targeting, making sure that the smallest businesses can get access, even they don't have the kind of banking relationships that were needed, is achieved, and probably putting more flexibility into this. And a way to try to tie up these payments to what's happening on the public health front, right? So right now we're going kind of one round of government, kind of support at a time. If there was something more automatic in terms of keeping on supporting these businesses as the public health crisis continue, that would be, I think, really, really useful and important.
Thank you. So Chi, I wanted to ask you and this kind of incorporates one of the questions one person asked. So we have these big disparities by race that existed prior to the pandemic. And the person asked, well, why do these disparities exist? What can we do to overcome them? What can we do to change the situation? And so going forward through the pandemic, what do you think is causing these big racial disparities, both prior to the pandemic and both during the pandemic? And what, in your view, can policy do to help address these disparities across race?
Now that's a big question. So that's, that goes to a lot of root causes. So what we do see is that for minority-owned businesses, they have a hard time scaling up. So, and this could mean a lot of things. It could be access to markets, access to larger contracts, whether it's with government or larger companies. So that kind of, help to kind of gain in size and scale up, that really provides some, buffer when times are bad. So, I mean, in a case like this where demand is completely down, maybe that's, less of an issue. But in general, like larger businesses, that has a more diversified customer base or client base, that are not just dependent on, their own neighborhood, they tend to do better. They have more revenue sources, they have more revenues, and if they lose any particular customer, it's less of a hit for them. So really we'd like to see more help for Black and Hispanic owners, own businesses, to opportunities to scale up, to invest in and reinvest in their firms so that they can grow and become one of the larger small businesses that we see from Professor Bertrand's research, that they did do better during this pandemic than the very smallest ones did.
Thank you, Chi. Maurice, and I'm going to kind of incorporate something that someone said. So people were asking, they love some of the things LISC is doing. They wanted to know if LISC is doing this everywhere or only in communities you're in. But to incorporate that, I mean, you've talked a lot about building extending financing in a better way, and also extending this business ecosystem. I guess what I would ask, you're doing some great things in that regard. What should the federal government be doing to promote this? Someone asked whether small business development centers are really set up to do this properly, or is there a problem there? What can state governments be doing, or even local governments be doing to help with this financing ecosystem? And for that matter, what can other philanthropic institutions and nonprofits be doing around the country to help support this financing ecosystem? What would you be pushing for there?
Yep. Let me try to answer all of what I think you asked. Tell me if I missed something. First of all, we are doing this everywhere. We're doing it through our 35 markets where we have offices, plus we've got about 100 rural partners serving now 45 states and 2,200 rural counties. So this is all over the country that we're doing this. Second, on the extending financing, again, I think we have to have a much bigger picture. The federal government has to have a much bigger picture of the financing infrastructure in the U.S. as they think about policy solutions. PPP was designed with the banks in mind. And as a result, in the first round, that's who got served, bank customers. Now, to their credit, they made an adjustment and they allowed more people in, but they were missing the fact that the mainstream financial institution does not serve small, Black-owned, women-owned, rural businesses well, and that's part of the challenge. But there is a larger financing system, and what the federal government needs to be thinking about doing, as well as state and local, is how you build the capacity of this broader financial system that is serving these businesses, that does have relationships with them. This ecosystem piece is critical. And what the federal government and what the state government, what local governments and what philanthropic organizations can do is provide the kinds of capacity building investments, philanthropic loans, incentives to invest in this system that will build its capacity to serve these smaller businesses. And in particular, now we need to build the capacity of this ecosystem to help small businesses with technology issues, right? Being able to work remotely. We had to set up in one of our markets a small pool of funds so that small businesses could come to us and get grants to buy laptops for their employees to be able to work remotely. These are the kinds of things that a concerted, intentional effort to build this ecosystem can have dramatic impact. Let me just say one last thing. Look, the PPP program, if you're going to really serve small businesses, that's not the right product for the long term. That's a product that was designed with employees in mind and keeping people employed. And as a result, the money, first and foremost, went to large businesses where you had large numbers of employees. If you're really going to invest in a small business surviving and reconstructing, you've got to have a more longer term product. A 60-day product or 8-week product is not. So we've had small businesses who have refused PPP loans from us because it wasn't the right product for their longer term needs. So I want to see less focus on PPP, to be honest with you, and more focus on what these businesses need in the way of reconstruction assistance for a longer term. That's what I'd like to see. And that's certainly what the small business feedback to us has been.
Maurice, one question from the audience that I think would also be appropriate to ask of you is an audience member asked, could you discuss any trends on how rural businesses are faring during the pandemic? What are the special problems there and perhaps different solutions that might be needed?
So rural businesses have had a particular issue because of the lack of broadband. And so the most important thing we could do for rural businesses is to invest in a national effort to get more broadband in rural America. Even in the wealthiest states, Virginia is in the top 12 or 15 states measured by wealth. 40% of the Commonwealth of Virginia is without access to high-speed internet. Internet is like oxygen for businesses. So what we're seeing in the rural areas in particular is what lack of access to broadband has done. And so we've tried to do some digital inclusion work in the rural areas in ways that have been more intensive than in the urban areas. And boy, the need for that is pretty dramatic.
Another question, this might be appropriate for Chi to address. And the question is, if a minority small business closes and defaults on a loan, it can blemish that entrepreneur's credit and make it even more difficult to start a new business. How can we avoid this situation so entrepreneurs, particularly minority entrepreneurs, can bounce back after a business failure that's really being caused by the pandemic, not anything that really is the business's fault?
I am not sure I'm the best one to answer that. It might be Maurice. For that.
I can take a go at that for sure. Look, we have spent an enormous amount of time restructuring loans for these businesses, and every financier in this market should have a compassionate business view. And so we have been pushing back maturity dates, pushing back interest payments, doing deferments, doing amendments, doing restructurings. This writer is right on target. We've spent a lot of time trying to make sure we're working hand in hand with the borrower to make sure that we are actually giving the borrower the kind of forbearance it really needs to stay out of that kind of trouble. To do that, though, you have to be willing to be hands-on. Again, another reason why a CDFI is one of the best ways to do this, because we see that as part of our job. These loans are not transactions, they're relationships for us. But you've got to be willing to use the tools that you have to amend your loans if you want to do that kind of work on behalf of these minority and other small business borrowers. And it absolutely can be done. Absolutely.
A couple people asked a question I think I'll address to Marianne first, though, of course, if the other speakers want to chime in, that'd be great. And the question is, we're now facing potentially the $600 weekly for unemployment insurance going out. What impact is this going to have on the market base from any community-based small businesses? What kind of forecasts do you have for that?
I think it's really scary. I mean, it is very clear that the additional generosity that went into the UI has helped a lot of these workers that got displaced by the crisis, and the fact that those workers that were displaced had some buying power has helped support some of the businesses that are still alive. Thinking about what will happen if all of these early workers are not going to rely on much lower kind of unemployment insurance support is scary. I mean, as I showed in the presentation, kind of the workers that have been most affected by the crisis are low-wage workers, minority workers. So it's very doubtful that they have a strong kind of informal safety net, family safety net. So the buying power of these workers is going to be very minimal, and that will, trickle on the other businesses as the buying power in the economy is going to be going down. So I find this very scary.
Thanks. Another question we got that it could be addressed, I guess, by Maurice or Chi or Marianne, really all three of you, but what policies should state governments be pursuing to help minority-owned businesses, especially assuming limited funds, which they're going to have unless there's some kind of fiscal aid for state and local governments. Chi, do you have any thoughts on what state governments might do given these problems? If you were governor, what would you be doing?
So I'm not sure that it's any different than for any other level of government, but really, if we're looking at these small businesses, let's rebuild them. And echoing what Maurice said, especially for minority-owned businesses that are less likely to be employer firms or be very large, make sure that these any thresholds about size or number of employees don't exclude a number of very vulnerable businesses.
Yeah, I would just add a couple other things. State governments are in great positions to guarantee small business loans. So you've got a number of state governments out there that actually have small business loan guarantee programs. And those programs are really helpful in enabling people to take the kind of risk that are going to be needed to take to give these small businesses the kind of capital that they need to rebuild. So one thing I would think about all state governments, and many of them are already doing this, is establish a small business guarantee program. That's one. The other thing that state governments can do is use their resources as a leveraging tool. Let me give you an example. We now are managing a fund for the state of New York. What the state has done is they have actually made a $20 million contribution. It's essentially grant dollars that we're using as a loan loss reserve. We're using that loan loss reserve to leverage $80 million of small, low interest loan capital that we can then provide to small businesses. And so that $20 million is really the loan loss reserve and the cushion that has enabled us to then attract from philanthropic sources and from bank sources the $80 million that we're going to use to lend. So I would say to state and local governments, when you're thinking about your assets and resources, leverage is what you need to be thinking about, and how you can leverage that to do the kind of work at the scale that you really need. In New York State, only 20% of the small businesses got access to PPP loans. So they're trying to serve the other 80%, and they're using their capital as loan loss reserve.
Okay, and another question that came up earlier that I thought was an interesting question. I don't know if any of you have had a chance to look at this. They wanted to know, what about small businesses where there are property owners that fall into the small business category? That is, people who own some property and they rent out to small stores. And, you know, if they're having financial problems, that then ripples through the small business ecosystem. Do any of you have done any work specifically with small businesses that fall in the category of small apartment owners or retail business type operations? Have you worked with that group? Any thoughts there, either Chi or Maurice? Have you done any work on that?
I have not.
So I missed the last part of that. These are
small businesses are property owners that own, say, a building, and they rent it out to another small business, say, and maybe they're having problems because maybe they're not collecting rent now.
Yep. Again, I guess we have seen some of that, and that's a sort of a compounding problem. We are actually working with property owners who have who have tenants who are not paying, right? And what we're doing there is usually we're working on the financial side. We're trying to give them the kind of flexibility they need to actually to be able to miss payments. I think you can see.
Whoops.
Sorry
you went
about
out
that.
For a second,
I went
Maurice.
out. Yeah, I apologize on that. You can see that issue on the residential side as well as on the commercial side. Again, what we're trying to do is infuse the kind of capital into these businesses to help them to withstand that kind of, if you will, delay in payments, and that's where the notion of amending their obligations to us is coming in. So that's how we're trying to be helpful in that situation.
Okay, well, unfortunately, we need to wrap up now, and I really appreciate the contributions by all three speakers, as well as the very good questions from the audience. And I'm sorry you couldn't get to all of them. And again, this is part of a webinar series, as I mentioned, Research for Equity and Recovery. And we do plan on having more webinars in this series. We want to make sure that no groups are left behind this recovery. And the webinar was recorded, and the slides, along with some links to research at the JPMorgan Chase Institute, at LISC, and then links to Marianne's research will all be posted there as well. So if you want to follow up and learn more about this research, it will be there later on, probably later this week. So I'd like to thank everyone for attending, and have a good day.